Most people are not overpaying taxes because they're bad at math. They're overpaying because they believe rules that are just flat wrong. They think an LLC automatically saves taxes. It doesn't. They think a bonus is taxed at some crazy higher rate. It's not. They think filing an extension means you don't have to pay yet. Wrong again. Look, I've been a tax attorney since the 90s, and I can tell you this. Some of the most expensive tax mistakes people make start with something they know that is not actually true. So today I'm going to give you the top 10 tax myths that cost people money every single year. And let's jump in. Number one, it's the LLC saves you taxes. This one costs business owners a fortune. People hear you need an LLC and they think they just solved their tax problem. They did not. An LLC is a legal structure under state law. By itself, it usually is not a tax strategy. A single member LLC is generally disregarded for federal tax purposes unless you make a separate election. That means the income usually ends up on your personal return anyway, unless you choose to make it into a corporation. You get to choose that. And here's where the myth gets expenses. A lot of business owners form the LLC and they stop there, and they never realize that they need to separate tax election. They need to choose how they want it treated for tax purposes. And so they need a separate tax election and actual tax planning if they want to reduce things like employment taxes. The money loss is not in forming the LLC. The money loss is thinking the LLC was the strategy. It's not. It was step number one. Number two, this is the bonus myth. The myth is that your bonus is taxed at a higher rate than your salary. And this one is everywhere. People get a bonus, they see a big chunk withheld, and they say, see, bonuses are taxed more. Usually no, they're just withheld differently. For most people, that withholding rate is going to be 22% to 37%. That 30% rate only kicks in if your employer pays you more than $1 million in bonuses in a single year, which applies to very few people. But when you file your tax return, that bonus is still reconciled through the normal tax bracket system as ordinary income. Why does this myth cost people money? Because people misunderstand whether enough tax was actually set aside. If your real marginal rate is higher than the withholding rate, you owe more than you expected. If it is lower, then you may have over withheld. And the point is this: do not confuse withholding with your final tax liability. They're not the same thing. Number three, tax deductions. The myth is that a tax deduction and a tax credit are basically the same, and they're not even close. A deduction lowers the income that you're taxed on. A credit lowers the tax you owe dollar for dollar. So if you're in the 24% tax bracket, a $2,000 deduction might save you $480. A $2,000 tax credit, on the other hand, saves you $2,000. And that is a huge difference. And this myth costs people money because they get excited about deductions without asking the only question that matters. What is this actually worth to me? I buy the G-Wagon and get a big deduction. What is it actually worth? Because not all tax breaks are created equal. Number four, let's talk about your bracket. This one drives me nuts. The myth is that your tax bracket applies to all of your income. The myth makes people afraid of making more money. They think if I move into the next tax bracket, the IRS taxes everything at that higher rate. And that is not how it works. We have a progressive tax system. Different layers of your income are taxed at different rate. Only the income above a threshold gets taxed at that higher marginal rate. And this myth costs people because it causes bad decisions. They turn down raises, they turn down income. They avoid Roth conversions that may make sense. They put off gains that they should recognize strategically. They're making decisions based on a misunderstanding of how the tax brackets actually work. Number five, dividends, and specifically, we're going to be talking about reinvesting them. The myth is that reinvesting dividends makes them not taxable because you never touch the cash. And that is wrong. If dividends are paid in a taxable brokerage account, they're going to be taxable in the year you receive them, even if they're automatically reinvested into more shares. The IRS is very clear on this. And yes, this surprises people every year. Why does it cost them money? Because people get blindsided by taxes on income they never spent. They never saw the cash. And some also do a poor job tracking basis on their reinvesting shares. So now they create one tax problem in the current year and another one later when they actually sell. It is an issue. Number 6, big refunds. The myth is that a big refund means you won. No, it means you overpaid into the system. A refund is not free money. It is your money coming back to you after the government got to use it all year long. In other words, you gave the IRS an interest-free loan. Now, some people like that because it forces them to save. Fine, I get that. But let's at least be honest about what is happening. This myth costs people money because they celebrate over withholding instead of just adjusting it. And when your cash flow is tight, that matters. Maybe you have money on a credit card that you should never have had. You paid interest that you should never have paid. Number 7, Social Security. The myth is that Social Security is tax-free. For many retirees, it is not. Depending on your combined income, Social Security benefits can become taxable. And it happens in 2 stages. If your combined income is above generally $25,000 as a single filer, $32,000 if you're married filing jointly, up to 50% of your benefits can be taxed. But here's what really surprises people. If your income climbs above, right now I think it's $34,000 if you're single or $44,000 if you're married, up to 85% of your Social Security benefits can become taxable. And that is not a typo, 85%. And those thresholds have never been adjusted for inflation. So more retirees get caught by them every single year. And this is where the myth gets expensive. People enter retirement assuming Social Security is clean, tax-free income. Then they add in their IRA withdrawals, their pensions, part-time income sometimes, or other cash flow, and suddenly more and more of those benefits are taxed than they expected. And that is why retirement tax planning matters. Not just how much you saved, but how you take it out. Number 8. Extensions. The myth is that a tax extension gives you more time to pay. No, it gives you more time to file. That 6-month automatic extension, it gives me from April to October. That is just when my return is due. But the IRS is explicit. An extension to file is not an extension to pay. If you owe and you do not pay enough by the deadline, penalties and interest will start adding up. And this myth costs people money every single year. Someone files the extension, they relax, and they think they have 6 more months across the board to pay things. They did not. They only delayed the filing of the return. If you owe, you still want to pay as much as you can by that original deadline. Otherwise, you're paying potentially a lot of extra money. Number 9, the myth is that all income is taxed the same. This is the fun one. It's not. Wages, you get hit on, you're going to have employment taxes, federal taxes, state taxes. Capital gains might be taxed at a completely different rate and not be subject to employment taxes. There's qualified dividends versus ordinary dividends. Qualified dividends might be taxed as long-term capital gains. And then there's real estate income. And they can all be treated differently under the tax code. Qualified dividends and long-term capital gains can receive preferential rates, sometimes 0, while the wages like that I earn are taxed as ordinary income, and they're also getting nailed with an extra layer of taxes called Social Security taxes and Medicare taxes. This myth costs people money because most people focus only on how much money they make and not how they make it. The tax code rewards some behavior more than others. And it's not politics, this is just how way the rules are written. If you do not understand that, you can work harder and harder and still keep less and less. So again, I could be working at McDonald's and paying a much higher tax bracket than the dividend income that I'm receiving off my portfolio. Number 10, the home sale. I'm just going to write down 121 exclusion. The myth is that the home sale exclusion is small, rare, or one time. It is one of the most powerful tax breaks in the tax code. If you qualify, you can exclude up to $250,000 of the gain on your home, up to $500,000 if you're married filing jointly. This is on the sale of a principal residence that you lived into at the last 5 years. And it's generally not a one-time lifetime rule. It is enormous. You could be using it every 2 years. And this myth costs people money because they do not plan around it. Some people sell without understanding what they actually qualify for. Others think that they already used it when they can never use it again. And that's not how it works. When used properly, this can be one of the best wealth planning tools available to just regular Americans. Trade up your house. Don't pay tax on it. And here's the bigger lesson. Most people are not overpaying taxes because they're lazy. They're overpaying their taxes because nobody ever explained the rules in plain English. And when you believe a tax myth, you do not just misunderstand the system. You make worse decisions with real money attached to them. So tell me in the comments, which one of these myths did you hear the most or did you believe? And send this video to somebody who thinks that an LLC automatically saves taxes, or that a bonus is tax higher, or that an extension gives them 6 months extra to pay their taxes. And if you want more content like this, subscribe to the channel. Please like this video. I break down tax strategy, asset protection strategies, and the legal moves that help you keep more of what you make on this channel. And before you go, I have 2 free things for you. First, we teach a tax and asset protection workshop. It's a live virtual event where my team walks through the exact strategies we use with real estate and business owners, absolutely free. Spend a Saturday with us. Second, you could use a free strategy session with one of our advisors. No pressure, just answers specific to your situation to see if you could save some money. I'll leave some additional videos for you if you'd like this type of content as well, but don't forget to like and subscribe. God bless.